right, how's everybody doing? Good, can we get a little bit of energy going into this panel? All right, all right. Thank you, thank you. I know it's us and maybe one more before you guys can start drinking, but please, I think we'll have a lot of interesting stuff to talk about today. My name's Ryan, co-founder, CEO of a company called Vaults.fyi. I have a single API to integrate DeFi into your products. And I'll kick it over to our panelists just to introduce themselves real quickly, and then we'll get into it.
Hi. Owen Simonin, CEO of Meria, stacking provider.
Hi, I'm Arthur Breitman, co-founder of TezDev.
I'm Dmitry Kovalevskiy, founder of Hanji, onchain cloud DEX.
Awesome. Well, if I had to say what one or two of the big themes of this week feel like, DeFi Earn is definitely one of the topics that it feels like everybody is very interested in. And so I'm curious to speak with some of our panelists today about, because I think there's a version of this panel where we could come out here and we could say, hey, everything's going great. Everybody's starting to integrate these Earn products into their suites. Like, it feels like things are kind of going in the right direction. I guess from what you guys are seeing or starting to integrate, what are the things that are still being solved to get companies comfortable with integrating DeFi, or kind of challenges that still exist out there? I'll leave it as an open-ended question. Feel free.
I just can imagine from my talks with from people from brokerages. So we're not. A lot of them were launched like TradFi yield. For example, companies who offer services for SMEs in Europe. A lot of them are launching yield products, but they are mostly based on T-bills. And I think when it comes to discussing crypto, first it's hard for them to measure the risks, and especially career risks for them, because if they put client money into BlackRock, and even if something goes wrong, it's okay. But crypto is very hard to measure. Like, there isn't a resolve incident. It's hard to reason about, and it's a wrong situation to be in. To address it to your boss. And secondly, I guess regulation and the need to be able to convert to stables. But this is getting solved, I think, right now.
Yeah, I think the thing that I find interesting around yield in crypto is that there's an arbitrage that's still not been closed, in the sense that you've had structurally higher yields in crypto than you had in other lending markets in dollars terms, and you can't explain it only by the risk. Some people will say like, oh, crypto is risky. It's like, I mean, not necessarily. So I guess one part of the risk is like, if you are unable to tell the difference between, like an Aave and a Luna, for example, then yes, that is a risk, because you need to understand, but I don't think it's, that profound to know the difference. The second thing is smart contract risk. But I think even accounting for all these risks, like the yields have been much, much higher. So second category explanation is that there's a capital shortage that's willing to lend in crypto because institutional lenders don't want to touch DeFi pools or others for regulatory reasons. Those have been historically the two. And of course, the yield varies. There's a strong correlation between being in a bull market and having higher yields in crypto, because at the end of the day, like, the yield comes from people wanting to have leverage, primarily in crypto, and that's the source, and that is much more prevalent in bull markets. There's also other sources of yield that you see. You see sources of yield in staking, and even if you want to yield in dollar term, like staking hedged by perps, like on Tezos in particular, but on a bunch of other coins. The market between like properly staking your coin and shorting a perp, which synthetically give you dollar yield, is also not closed, and it's a bit surprising why that's not the case.
From the retail market and from my YouTube community and this kind of thing, I feel that people are looking to invest in two kind of things. One kind of investor are looking for high yield, always looking for the last liquidity providing, sometimes the last staking solution. And one kind of investor are looking for the reliable yield. And from that point, it's always funny to see that from the point of view of the user, DeFi user, they have to look to find and to understand all chain, all protocol, and all solution to get the yield. And from the side of institution, they just want to integrate the partner, allowing people to access to a regulated path to get this yield. So I think we will need a few years more to have the answer of what is the best way to get the yield, and also what kind of yield we have to distribute to people.
Yeah, great points all around. And Dmitry, I'm glad you brought up risk because, I think it's a very challenging thing because if you think back to the last time crypto really went heavy on pushing yield onto users, it wound up being the Celsius, FTX, Gemini Earn exploding. And so I think there's a lot of people that have some PTSD from that. Obviously, this time around, it's very different in that everything now is kind of on-chain. But on-chain introduces kind of a new set of risk vectors. I think as we saw probably this past weekend with Resolve and all of that, which again, I think was something people wouldn't expect. So how are you guys thinking about kind of this new wave of risks and how we can better communicate some of the things that exist now with smart contracts and all of that?
Yeah, it is a communication challenge again because people tell you like, well, the risk is high because the yield is high because there's lots of risk, and you say like, actually not that much, and you say, well, look at this and look at that, and it's so silly because when you look at something like Celsius, they had a fantastic business, they potentially had a fantastic business model, which is collect the yield on DeFi on the one hand, do like like well collateralized lending, and the other hand, offer a money market, like that institutions can plug in or people can plug in and get a high yield. And they could have done this, and they could have earned a ton of money, and slept very well. And instead of that, they had to do the dumb thing, and do a bunch of insecure loans and get into like liquidity provision as a sort of yield, even though it wasn't hedged. And they did all this, dumb shit. So it's, I think people sometimes throw the word greed around when they just mean like wanting to make money, but this is, I think the definition of greed is wanting to make money in this, in a stupid way where you get, in your own way, and that's what you saw here. So it's hard to convince people that no, there's nothing like the yield is strictly higher because of capital shortage and not because of all of these problems, but that that is true. You have protocols where there's a lot of controls and you can see exactly what's going on and which have survived very, very well through a lot of adversarial conditions and which still have structurally much higher yields than money markets.
Yeah, I think the big problem for like broad retail, offering these products to broad retail, is the complexity of the crypto products. So basically the platforms like Celsius, they kind of abstracted all that complexity and just offered flat yield. But that ended in like custodial credit risks of these lenders. And if we offer like the DeFi platforms directly to the users, then we need to somehow explain it to them, and this is kind of complex because you need to make retail user understand that he's putting this not to your brokerage, but to like Aave, for example, through your brokerage. And this, I think this is a challenge in itself.
Yeah, I think great points. I think abstraction is kind of a double-edged sword, right? Sometimes it's good to understand what's happening underneath the hood. And I guess thinking a little bit more broadly too about where the future of sort of earn goes in crypto, right now the majority of what people are doing is variable rate lending. Obviously there are things like Pendle, which are immensely popular and kind of bring more fixed term components in. I'm curious if you guys have kind of seen anything interesting or have any kind of hypotheses around when fixed term lending or other types of lending could become more popular?
I mean, one way is just to kind of do it under the hood and just offer fixed term lending for retail. Or SMEs, for example, in Europe, which is like a probably better market. One way to think about it, I think, is just like a user acquisition channel, because you can just offer a bit higher yield for like fixed term, for like a reasonable size of like deposit, just to attract users, and I think it works extremely well.
Basically, it's a lot of institutional actors looking for fixed terms yield. The problem is you have to add an additional layers, basically, and if you add an additional layers, you are also adding an additional risk in your investment. So from the retail, I never hear about people looking for fixed yield only. So predictable finance is always interested, but I think that at the moment, it's not the priority of many users.
Fair enough, yeah.
Yeah, I mean, you have also to look at the demand. So essentially, like, people are, it's not just people are lending, in variable in instant rates. They're also borrowing in instant rate. And you would think that from a borrower perspective, if you want to leverage your assets, you might want to lock in a funding rate so that you don't get pushed out of your position with the funding rates. But I think a lot of it is short-term trading. So people are not that concerned with, like, they don't want to say, like, I don't want to hold this position for 6 months. So probably it's the demand side of the equation, and you can still offer long-term rates and locked rates, but then it means someone has to take basically the risk, and someone has to say, like, hey, I'm willing to take that swap and to make the market here and carry this, like, rate trade on my books. And there's just not that many, like, first of all, there's not that many people who know how to price this well. And second, there's not that much capital who's, like, in DeFi and sophisticated enough to want to, like, go and make a market in this.
Well, speaking of not knowing how to price collateral types well sometimes, if there's another big theme I'm kind of coming across this week, it is everyone trying to get RWAs into their products in some way, shape, or form. Most of the attempts at this historically have been things kind of like private credit or real estate, which I think for a number of reasons are not particularly suited to be brought on chain. But Arthur, obviously you guys are doing a ton now with metals.io. I'd love to kind of hear from you too how you imagine these commodity-like products kind of fitting into the earn stack and kind of user activity here. I mean, either as collateral or wherever that may sit.
Yeah, so I think part of the issue is that a lot of the early issuers of RWAs were essentially people who were looking at blockchain as distribution channels. So they were saying, like, hey, this is like 2017, 2018. There's a lot of people who made a lot of money in this space. And you know what? I bet they're very upset that they hold these very volatile thing, and they want nothing more than to get into my real estate project. And I haven't been able to raise money for my real estate project. I know I'll put it at risk. And of course, there's just no product market fit here because the type of investors who's interested into real estate is very different from the type of investors who hold a token. I think there's far more overlap with commodities. A lot of the people I know that got really early into Bitcoin, for example, and I mean, like 2012, they were people who were commodity traders, and commodity traders got it. The equity traders, they were like, where's the discounted cash flow? Commodity traders is like, no, it's supply and demand. I get that. So I think there's more of a impedance match with commodities, but even with uranium, we found it quite hard. So lots of interest from institutions, but they're like, they're cautious because it's a token. Whereas the crypto public, it's there, but they're like, yeah, is this going to make me a millionaire by Sunday? Right. So we're still in this kind of like a little bit of a no man's land in between that needs to be tweaked to really get this adoption. But I do think that commodities stand a better chance than real estate. And one of the advantages as well is that the regulation around commodities is closer to the regulation around cryptocurrencies, and so that makes it much easier, much more to put them into exchanges and dexes and all of that. Now, to your question, on like getting onto the earning stack, it depends if people want to get leverage against them. It's also possible that a lot of people will end up getting their leverage via perps. So sometimes people point to perps and say, see, we don't need a spot market. We don't need a lending market. That's quite true, because if you want your perp to be in line, someone needs to take the other side. And then that might be someone replicating the exposure synthetically by taking a spot position and borrowing against it. So maybe we see some of that, but it's a bit early for that.
Yeah, I'd say that like retail is mostly attention driven, and so I wished we added oil as well in the past few weeks. So before that, I don't imagine a lot of people trading oil retail, but like in the rest weeks, I think we'd have quite a lot of attention and volume and activity. So yeah, you should just really add those assets and hope that you will not need them, but if something happens, then you will have volume. I think also like probably we're in a new environment now, which where macro makes more sense. There's unfortunately more events, and so there might be more activities in commodities and also currencies. So yeah, that might be more interesting for retail now.
There's a saying, I'm not claiming there's some truth to it, it's not 100% true, but there's a saying that says that stocks take the stairs up and the elevator down, and commodities take the elevators up and the stairs down. And that's the thing with commodities. It's like you said, it's like sometimes they just spike to ridiculous amounts very, very quickly, and then yes, you get a lot of interest. If this happens to uranium, I would predict that yes, people would get a lot interested. It's like it's the old meme. It's like uranium at this price, like no one's interested. Uranium at 10 times the price, like now I want to buy it.
Yeah, I think when I think about RWAs, what I'm really excited about is just having better additional forms of collateral in lending markets in crypto, really. One of my favorite examples here is if you go to Base, which is a big network for DeFi activity, and there are Morpho markets there, it's almost entirely one collateral. It's all borrowing activity almost exclusively against CBBTC. So like for some of these networks, for some of these protocols as well, it really is just finding one great asset people want to borrow against and sort of going from there.
Yeah, but people don't buy an asset because it's collateral in some sense. It's not like these people say like, geez, I want to borrow. I know I'll buy some Bitcoin and then I'll borrow against it. They want to hold Bitcoin in the first place, and then they happen to want a loan. So it has to start with like people wanting the assets to begin with, right. Or like maybe already like being holders of the asset and saying like, sure, I own this thing anyway. Now that it's tokenized, I get to like borrow against it, which is more convenient.
I think for retail, it usually starts with a bad trade. So you buy a lot of some commodity, and then it goes down, and you start to borrow against it to not close the position.
Yeah, we'll kind of segue in a bit. We've talked maybe a little bit more here about kind of some of the institutional side and what all that looks like and may feel like. And something I've been kind of thinking about when it comes to Earn and kind of DeFi generally is what does like what Robinhood kind of did for stocks, maybe Revolut did for something like Forex. What does that look like today for DeFi? And I know you're kind of building something here as well. I'd love to maybe hear about that and kind of how you're thinking about that coming together.
It's always too complex to answer to this question because this market is going so fast. And I think the Robinhood of tomorrow is very complex to think today, but that can be Robinhood or Revolut. The problem, is it a problem? That is the question. But finally, at the end of the day, blockchain is just a technological basis. So it's a way to distribute, to hold, and to interact with different kind of assets, from crypto, from stablecoin, or also RWA and all assets behind this family. But at the end of the day, users are looking for a very simple interface. Institutions are looking for regulatory path and compliance. And basically, you have to hide this regulatory path, this KYC, all this different friction when you have to onboard a customer to being able to distribute your product and, if it's possible, earn module and yield with that. So I would not be surprised if Revolut or Robinhood become one of the big companies of tomorrow, but I think behind the scene will be some tech provider, basically DeFi protocol or also staking provider and this kind of thing, able to answer with financial and compliance flows to this distributor.
Yeah, I guess riffing on the compliance flows a bit, one, what does that kind of look like for you? And sort of connected to that as well, I imagine you've spent a lot of time talking with regulators. Arthur, you've probably spent a lot of time, more than maybe you wish, talking with regulators. Dmitry, maybe a little bit earlier on that front. How has their understanding been as you're sort of explaining to them the flows of, hey, yes, we're going to allow our users to deposit into this DeFi protocol where they're then going to take out leverage and move their position on this other chain? And like, how savvy are you finding the people in these conversations?
We have two different kind of discussion. The first one is about the custody, because you have the segregation of the funds inside of your company and the different things you will follow to use and to place the fund of your customers. But from the technical side, from staking, it's different because you just have to explain and to vulgarize the risk. For example, the first native staking, I correct me if I'm wrong, but it's Tezos in 2017, 2016?
2018.
So when we discovered the staking, that was the first yield product based on proof of stake, and we really appreciate that for what? Because for the first time, in 2017 for Just Mining, now Meria, we was able to provide a yield from bank's deposit without taking the risk of custody. That's exactly the kind of discussions that we have with the regulator. That's why we have to categorize and to explain the different kind of risks from staking to DeFi product because you have different layers of risk, and finally RWA because it's different to have endogenous yield from like staking and exogenous risk and yield from RWA. Right. So it's different kind of discussion, but yes, from the staking and the yield, it's more a technical approach and the way that we will use some API audits risk because you always have some risk in your protocol, and the way that you will distribute a yield on an asset without taking any risk in the path.
So, I mean, I don't have that many conversations. I think the last time we've had some conversation, they've been around uranium, and like it's not even directly with the regulators. It's like with people who deal with the regulators. And I think one difficulty is them understanding that just because something is on a blockchain and is a token doesn't mean it's crypto.
Sure.
And for a lot of people, they still think this way. They see like tokenized uranium. You know, it's like, you know, it's a title, like it's a commodity. Clearly, it's not a crypto product. It's not a crypto token. It's like, oh, but wait, but you know, there's a private key and there's it's on a blockchain. That's crypto. But fundamentally, it's so, you know, it's funny because I remember years ago regulators saying like, oh, you know, regulation need to be technology neutral. You know, you think that you're different just because you're on a blockchain, but actually, it's kind of the opposite. It's like things have been treated differently and in general more poorly because they're on a blockchain. Not always than when they're on a blockchain. The counter example to this is stablecoins, which, you know, if anyone tried to do stablecoins not on a blockchain, they would have been stopped immediately. But like if you did it on a blockchain, it was all right. That was the exception. And
did that just come from a moment in time, or, you know, like, talk about that?
I think it's a matter of focus. I don't quite understand it, but you know, if PayPal had tried to like run the way that USDC was being run or anything like that by not KYCing any customer and letting all the transfer and then saying like, oh well, you know, if we get a report, we'll free some accounts, they would have had lots of trouble. But you could do it if you were doing it on a blockchain, and the regulators were not focused on that. They were extremely focused on other aspects like what they perceived to be issuers of crypto tokens, all of that took the front and center. So it's interesting. Yeah, it's a bit of a moment in time because it depends what they're focused on and how they think about the problem and where they think like the risks are.
Yeah, very interesting. I think, you know, kind of on some of this as well, one of the more forward-looking things, you know, I've been thinking about with my business, and I'll kind of pose this question to you guys, is I've been thinking a lot about kind of like who our users are today, and like if these are the people that in 2 years from now will still kind of be our largest segment of users. Like really kind of forward thinking of, okay, are the people here today still going to be the ones, you know, in some time from now? I'm curious how kind of you guys are thinking about that, and maybe even your roadmaps as well. Like the customers, the profiles, the ICPs that you have today, do you still think that they will be the majority of your, you know, however you measure it, volume, economic activity, et cetera, in 1, 2 years from now? Or what kind of new categories are you finding yourself excited about?
I think we can create the next wave of adoption. Everybody here in this room want to live again 2021.
Yeah.
The problem is we can't control that. And I think we reached the point where the next wave of adoption is not about convince crypto skeptic. It's to work on interface, UX, integrate institution and distributor, and providing the chain, the stack of technology to being able to answer of all the regulatory necessities from the different regulator, especially in France, and of course to address directly the final user, but through an institution. It's a bit funny because it's one intermediaries, and basically when we think about Bitcoin and this whole ecosystem, so we are working to reduce intermediaries, but we have to work with people already holding the trust of final user. Yes. So step by step and month after month, we are reducing the number of B2C and retail customers that we have with Meria, and we are distributing more and more exchanges, institutions, platforms, banks, distributing after us with our stacking stacks, the yield to the final customer. So more B2B2C.
Sure.
Yeah, a difficulty if you're in the L1 business, and sometimes you don't necessarily know who your users are. Sometimes you do. So for example, there's a big art community on Tezos, and it's easy to know because they're active on social media. So like they let themselves be known.
An amazing art community, yes.
Yeah, it's fantastic. But other times you don't know. It can be in DeFi, it can be in projects. So like it can be hard to know. People want to be anonymous, and so compared to almost any other like tech business today, you have a lot less knowledge of your users than you would if they've onboarded for you. If you have an email, and in essence, like. If you take a the business which have distribution like exchanges and wallets know a lot more about user behavior because you have a wallet, you can you see the transaction, you see the patterns, you can send like notification, you can see what people react to, you can see what they're interested in. You get a lot more information. Same thing with exchanges. Exchanges have demographics, have like loads and loads and loads of information. They can see those trends. They know what get people to take. It's a lot harder if you don't have access to this data. In terms of like who are the next users that are going to be crypto natives, it depends on the product. I think there's still going to be some very crypto native product 5 years from now that really cater to a crypto audience and it's going to be it's its own niche. And then hopefully what we're going to see is we're going to expand into different areas, and some of them where the crypto bits and rails will be more visible. Some of them where they will be less visible. But ultimately, it's not like a replacement. It's more of an addition of different type of community and different type of users.
Dmitry, I'll come back to you on this, but I just wanted to follow up on something real quick. I'm curious if Arthur, between Etherlink and Tezos, kind of if you've seen like new user populations pop up to the best as you can tell, or what you're seeing there too?
Yeah. So we had some incentive campaigns around DeFi on Etherlink, and I did bring new people who were more into the EVM world and who had not really been active on Tezos or on DeFi, and who came in and participated in the campaign, and some of them stayed and are still active in this environment. So we did see some new users, but it's still very much in the crypto native ranks.
Absolutely. I will mention we just added support for Etherlink on vaults.fyi as well, so you can access all your DeFi there. And Dmitry, kind of same question to you. I know you're much kind of early in the journey here, so.
Yeah, so currently it's mostly crypto natives, but I think in the future, it will be just regular users who would come because our platform is better than the TradFi equivalents. I mean, we have some technological advantages, like settlement is instant, for instance. We have some regulatory arbitrage. It's like easier to onboard. We see that stable coins are getting more and more adopted, and currently it's, I think, the most difficult part in onboarding non-crypto natives is to have them get stable coins from their bank accounts, for example. Yeah. And that is getting easier and easier. And so in a few years, I think the stable coins would be the kind of the standard that they hold. So then, I mean, if in the near future we would have users with stable coins already, then getting them to trade on a DEX would be even easier than getting them to trade on like Forex brokerage or like Robinhood. So yeah, I think we'll get tokenized stocks. We're starting to get in tokenized stocks, getting commodities. So basically we would have a lot of assets in the same context of a chain. And that would be much better than what they have right now for the instruments. Because I think in the US, you cannot even cross-margin stocks and a futures position, for example, like in the brokerage, because it's like different exchanges, so you have different accounts. And it will be possible to offer this on-chain because it's like same context.
Yeah, I noticed actually in our conversation on RWAs, we actually didn't talk much about tokenized stocks, and it feels like one of these categories that everyone's kind of perpetually very excited about. No perpetual pun intended, but continuously very excited about. And at the same, we've seen some acquisitions there, right? Kraken just bought X stocks, but still, it feels like on-chain volumes are relatively muted for on-chain stocks. Like, I'm curious in that category as well, where you see, your example makes a lot of sense, but where else maybe that makes sense for users?
Yeah, I think it's interesting the popularity, at least, if not in usage, at least in narrative of tokenized stock, and we took a bit of a different approach. So if you look at tokenized stocks, and a lot of them are saying like, oh wow, we tokenize NVIDIA stocks. From my perspective, it's like if you want to buy NVIDIA, you have so many options. You have so many ways to buy it. So many brokers will sell it to you. And I think what they were after is like people who do not have a brokerage account. They got, their first exposure to finance was using crypto. They have a wallet, they have money in their wallets, and they've heard of NVIDIA. It's a cool stock. They just want to buy it, and so they buy that, and they have access to it. So you're really marketing to like crypto users, like heavy crypto users who also want to diversify their portfolio. It's a bit more than that, like Dmitry was saying, it's like, hey, you can actually like, even if you have a brokerage, maybe you want to hold your stock in a way that gives you instant settlement, should you wish to sell, or access to, like different borrowing markets. So yeah, there are some benefits beyond this, but from my perspective, in terms of tokenization, I'd be more interested in trying to get long tail products which are super interesting, like that people might want to invest in, but which are not widely available. And so in a sense, when you tell them, when we say like, oh, RWAs, what is it going to be like? Well, the big things are tokenize NVIDIA stocks and tokenize US treasuries. It's quite accessible. So uranium it's a very, very different play in a sense. It's like, hey, this thing is interesting. And on top of that, we are the only game in town if you want to own it. That is, it's different take.
But the crypto world is always creating incentive to bring liquidity. So when you check X stocks, by holding your NVIDIA stocks directly on side of your wallet, you will generate points from X stocks.
Sure.
So the company working between Kraken, the new acquisitor, or the new owner of X stocks, and also Nasdaq, to bring traditional finance inside of blockchain, and you are generating points. And of course, one day probably earn something like hyper-liquid BIS. I don't know, but this kind of promise is also something from crypto and for crypto-native people. And I think at the moment, the tokenized stocks are more looking for native and crypto users. And traditional finance is about to come and to use this kind of path.
I would also add, like Arthur mentioned, that a lot of users are actually can't access US stock markets still, especially in emerging markets. And so having tokenized stocks can really make a difference for them. So if you're outside of US and Europe, then sometimes having access to US stock market is really difficult. So in such edge cases, I think tokenized stocks can make a lot of sense. But I also understand that stocks is really difficult because you have like corporate actions, you have dividends, and so it's might be painful to set up, but hopefully it is done correctly.
Now, single name perps are one way to do it. We haven't like single name perp tools on stocks are interesting. And
actually funny, but like in brokerage, some retail clients, they have strong preference for like spot stocks over CFDs. I don't know whether it translates.
Everybody okay back there? Just a camera.
No.
Oh.
Okay. Someone fell in the back. I hope they're all right.
Okay, all right.
All right.
See thumbs up. Don't want to.
We see some thumbs up. Let's go.
Don't want to be callous if someone's hurt.
Yeah, I was saying that anecdotally, some retail clients had preference on like stocks over CFDs for like single name trading. I don't know if it translates for perps or like if perps are fine. Yeah.
Please.
No, also like some people have preference for dividend-paying stocks.
Yeah, yeah.
Which, you know, it's more of an annoyance than anything.
Impossible to explain.
Interesting. Cool. All right. Well, I guess coming back around, just again, sort of on this go forward, I think one of the other themes we've seen out of the kind of mega companies has been trying to kind of do every financial action under one umbrella. So, right. So Robinhood, of course, leaning very heavily into crypto. Coinbase, I believe, sort of channeling, or maybe they've launched already, like stock trading or something like that. I'm kind of curious, especially on the Maria side, like. You have both the consumer business, you have the custody business, of course. Like, how do you think about trying to, because you also mentioned this B2B to C strategy. How do you compare that to evolving yourself into this single platform where you can kind of do everything for your users in a single place?
In terms of regulation, it's too complex to have everything in a single app. First of all, because when you are looking about Twitter, you think that people just don't want only finance. They also want communication, social network, AI, an investment tool at the same place. So creating the X, again, that will be complicated. And the second thing is you need different kind of license to distribute cryptocurrency. That will probably be different in the future than distributing stable coin. Like in France, you need to be MiCA to distribute some cryptocurrencies, and you will need another license to be able to distribute some yield on stablecoin. And finally, you also have for any RWA, consider it and categorize as equity today. That will be security, and you need to be MiFID. So I truly think that will be two different jobs to provide the platform and the one-stop shop of investment tools and products. Has creating the network, like blockchain or centralized distribution network, or finally the technical stack like staking, building block, MEV, etc. So I think you can target to be the biggest one and to create this tool, but it's different kind of work, and today it's not the job that we do at Meria. And finally, we have to be specialized in one segment and one path if we want to be able to provide and to create value and to distribute it through biggest platform.
Well, as we're coming up on time, I want to thank everyone for listening today, of course. I'm curious, what is something in crypto right now that you guys are most excited about? Besides, of course, what you're working on, whether it's something you're playing around with, something that you're sort of eagerly following, either on the research side, on the new launches. Curious what you'd suggest the audience give some attention to.
There's one thing I like, and it's not an endorsement. It's an endorsement of the idea. I don't know about the execution. I haven't looked into it, but I think there's this thing called Venturals, which are doing like single name perps on pre-IPO stocks, and it speaks to me because one of my first projects in crypto was in 2012. I tried to pitch that. It did not pan out, but it was built on Bitcoin, a futures exchange for pre-IPO stock at the time where people really wanted to trade like Twitter and Facebook and all that before the IPO. I think one of the reason for the success of crypto is that people have been cut off from early stage investing for a long time, and at the same time as like tech has grown immensely. We're seeing today a lot of tech giants which are still private, like the major AI labs, and there may be some IPOs coming, but I think there's far too little businesses go public, which is very unfortunate. And so trying to bring some form of liquidity to private markets or like to some form of access is it's a great mission, and I hope it pans out because that's extremely exciting.
Love that use case.
I'm mostly excited about like spot and perp trading developments. I think we would have more and more plays on composability and things that it can unlock. Yeah.
An aggregator of aggregator. We are creating the first tool where we aggregate our solution, but also all of our competitor. And it's for final user, and we are working on it for more than 2 years. And so For the moment, we are still building it. But yeah, I'm a bit enthusiastic from that.
Very nice. All right, guys. Well, thank you so much for listening. And yeah.
Thank you.
Yeah.